Hey there, it's Mike Langford. Welcome to the Augmented Advisor Podcast, brought to you by Blue Leaf. This week on the show, John Prendergast and I are diving deep on ESG investing with Nick Cantrell, founder of Green Future Wealth Management, and James Katz, CEO of Humankind Investments. If you're not familiar with ESG investing, which is short for environmental, social, and governance investing, don't worry, because our guests, Nick and James, are two of the leading experts in the field, and they are really good at breaking things down Barney style, as they say. Now, a couple of quick notes before we jump in. We are going to be talking about running a profitable business and producing high-quality returns for your clients. This isn't a nonprofit kumbaya fest up in this joint. We are all about running a profitable financial advisory business, okay? Number two, while the high-level topic is ESG investing, the actual topic is how to serve your clients' needs and wants more effectively and completely, all right? Okay, as always, please make sure you subscribe to the podcast on your favorite podcast platform. We're on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or guest for the show, shoot us a note at podcast@blueleaf.com or hit us up on the socials. Blue Leaf, John, myself, we're all active on LinkedIn, Twitter, and pretty much just about everywhere else, okay? We're super easy to find. All right, enough blabbering from me. Let's get to the conversation with Nick Cantrell and James Katz. Well, Nick Cantrell, James Katz, so wonderful to see you on the podcast. Welcome to the Augmented Advisor Podcast.
Thanks for having us.
Yeah, thanks.
Yeah, great to have you both here. And very excited to talk about ESG. I think it's something Mike and I have been talking about a long time now and thinking about having folks on the podcast to get the skinny on ESG. And, you both have fascinating stories about how you came into to starting to do ESG and make it a foundation of your business. I'm wondering if you wouldn't mind sharing that journey and tell us why you felt it was worth pursuing. And Nick, why don't we start with you with your advisory business, and then James, we can go to your larger context afterwards.
Sure, thanks. So I've been an advisor for almost 15 years and have been pretty focused on ESG for the last 10 years or so, and it's been growing. And I actually launched my firm, Green Future Wealth Management, last year and split off of a larger multi-billion-dollar national firm, really just to hone in and focus on helping clients align their assets with their values. And so we're not exclusively ESG, but we're probably about 75-80% ESG. We don't have a specific ethical mandate that we sort of shoehorn everybody into, but we work with a lot of folks on customizing based on their specific value set.
Fantastic. And, how long did it take you to transition to this sort of ESG focus?
I would say it was a slow burn. It was, there was 15 years ago, there was almost nothing to educate advisors on ESG, and clients too. Actually, there was almost no publicly available information on it 15 years ago. And about a decade or so ago, I had a group of clients that really wanted to pursue it, and I sort of went out to the world and tried to educate myself on it, find products on it, and was able to put together some what today would look like some pretty rudimentary or basic ESG portfolios, or so the SRI right then. I don't think ESG was really the nomenclature of the day. And then over the last decade, it's become more and more a larger part of my practice. And there's not a ton of advisors that really offer it, particularly customizable ESG. So now that it's our exclusive focus with financial planning and ESG integration, It's how we go to market. And I would say 9 out of 10 prospective clients come to us specifically for that. That's how they find us. That's how we advertise. They're typically referred in for that if they're a referral source. So it's just been one of those things where gradually over time, more and more shifted that. And then it's culminated in leaving my previous firm to found Green Future specifically to focus on this.
And James, that transition from no information in the marketplace to a much more common thing to hear about. I mean, really, you and your firm are trying to drive that. Why don't you tell us a little bit about your story?
Sure. So I was working at a huge fund provider in the Philadelphia area. Is one of the 3 largest ones in the United States. And while I was there, I sort of had this epiphany that these large asset managers control, maybe the top 3 in the United States together control something like 15% of the shares of all the publicly traded companies through the assets that they manage on behalf of their clients. And the raw power that they had to do something good, I thought was really, really impressive. The possibilities there were really, really exciting. So that's what sort of led me down this path into socially responsible investing, because it seemed to me like it was the way that everyone should be thinking when they invest, because people are never only investors, people are also customers, they're employees, they're members of society more broadly. Just take a simple thought experiment, like an easy punching bag. Say like a tobacco company, someone invests and they make $1,000 in their portfolio. That sounds great. But then maybe someone in their family gets sick and they have to shell out $10,000 in medical payments to help get better. And that's before you even take into account stress and quality of life reduction. So, was that a good investment? I would say not. And I think people have tremendous power through their investment portfolios to try to make the world a better place, not just through the sort of tobacco example that I gave, but I think that's just an example for a whole variety of issues that people are dealing with in their lives outside of their portfolio. So that for me was sort of this like eureka moment that I had, thinking about the power of ownership and how that could be translated to actually help make the world a better place. And the niche that I saw available when doing a bunch of research into the whole ESG, socially responsible investment space, was to try to quantify social responsibility. So, still today, I think there's a ton of disagreement over what ESG means, how it can be applied. And to Nick's point, his clients are coming to him saying, I have this particular idea or this particular set of values that I want incorporated. It's not so much that people are kind of putting the dots together to say, let's try to put a number on this, and what does this actually do for people? How does it impact people? So seeing that niche available in this space, that's when I decided to found Humankind Investments. We were in existence now for about 2.5 years. Our focus is on socially responsible investing, and specifically to try to quantify it. We offer separately managed accounts for high net worth and institutional clients, but we also recently launched a line of ETFs, with our first ETF launching in February of this past year. So, sort of an exciting time for us to be in this industry. I think there's been a ton of growth, in part because of the COVID pandemic, perhaps, but hard to say exactly. I personally thought that we were going to have to languish for a much longer period of time before this sort of caught on, but it seems to have really caught fire, very recently. Anyway, that's my journey into the space and Humankind Investments perspective specifically.
You know what's fascinating about that, and you really reminded me of it when we were talking about this in the prep call, James, and just now too. I think you hammered it home, but I think it's probably important for our audience to dive into this a little bit deeper, because I think sometimes when you think about, I'm going to put my investment dollars, my client portfolios, only in things that are ESG related, as an example, how is that going to shift things, right? Like, there's still going to be bad companies out there. There's still going to, you know what I mean? Like where I put my investment dollars isn't changing the world necessarily. I'm just I own some stock through a fund in a variety of companies, and my portfolio goes up or down or whatever. It's not like I'm on the executive board. But what you alluded to is like, listen, at a certain point in time, the fund managers have mass, right? They have power, right? They have that, kind of the government's power, right? That to force issues. And was it last year or the year before? I want to say it was the CEO of BlackRock came out and said, hey, we're about to start using our power pretty aggressively for certain issues that are important to us here. How do you envision that? And we didn't talk about this too much in prep, but I think this is an important line of questioning. How do you envision that being communicated to the end investor and to advisors, right? Like, how do they internalize like this actually becomes powerful? We can affect change for the world.
For sure. I think when it comes to the power that these large investment companies have, ultimately it's all about people selecting a socially responsible asset manager to kind of make those voting decisions on their behalf, because very often people aren't so actively involved in the proxy voting procedures of their particular portfolio. You sort of have to rely on your financial advisor or your asset manager if you're investing in a fund to vote those proxies and to really engage with companies on your behalf. What's really nice, I think, about this new push towards socially responsible investing, and in particular, of course, with Humankind investments, our exclusive focus on social responsibility is when people invest through us, they know that we work to vote the proxies in a socially responsible way. So it's not just that we're trying to select investments that are doing good, but we're also working to vote those proxies in a manner that's good for humanity, and at the same time, we actually also engage with companies, even if they don't make it into our portfolio. We engage with companies to let them know, hey, you missed inclusion, and maybe here's a couple things that you could do to try to make it the next time that we reconstitute an index or something like that. So we work to do all those things to try to actually make a positive difference.
Yeah, I'm glad you brought it up, Mike. I think you can make the case that the shareholder engagement and advocacy is the most important tool that we have to change corporate behavior beyond the negative screening. Hey, I'm not going to invest in tobacco or fossil fuel companies because I think they're bad. I think the ability to have a fund manager or an asset manager actually vote your proxies and beyond voting proxies, do direct engagement outside of shareholder meetings is probably the most important tool for change. And it's one of the reasons why, and we discuss this with clients where, we're not just looking to avoid the bad companies and include the goods. We're working with asset managers that are actively engaging with these companies to change their behavior. And it's a really important part of our selection process for who we're utilizing. And it's funny that you brought up BlackRock, and I might as well say it. If you follow me on LinkedIn, you might have seen me throwing shade at them last week because they did come out and say that the word that they used was purpose, and that corporations that didn't consider purpose were not going to be a good fit for BlackRock ESG holdings going forward, and that they were going to embed that in their culture. But then there's a resolution that was filed by BlackRock shareholders to get them to define how they're meeting their purpose mandate. And they just petitioned to have the resolution thrown out because they don't want to define their corporate purpose. And I was throwing shade at them on LinkedIn, and so were a few other asset managers, and I think that's fine. It's out there, you can see it. But I think that it makes asset managers or advisors like myself that are really focused on not just slapping green on the name of your company and hoping to capture some dollars from it, but if you actually view this as having the potential to nudge the world in the right direction, then things like that really matter. So I think you'll find that a lot of advisors and firms that are really deeply engaged in this space are a little bit skeptical of, some people would call it greenwashing, but certainly companies and asset managers and product manufacturers that maybe aren't in line with some of the ESG values that really underpin what our clients' values are.
Yeah, I actually really agree with that, Nick. In general, I guess maybe unsurprisingly, but in general, if you take a company that's sort of been doing the same sort of traditional finance for decades, like, is that the company that's going to, lead us into the transition to a new socially responsible world? I think these companies have an authenticity problem. In many cases, they're sort of the cause of a lot of the problems that we're sort of seeing today, in the sense that they haven't been considering these things in the past, and now they're maybe trying to start to. So what they're essentially saying is, we've done the research, we figured it out. These are the good companies, these are the bad companies, and we only invest in the good companies and these few portfolios. But then in all the rest of our business, it's business as usual, and we invest in all the evil companies. Like we never even did the socially responsible investing research in the first place. So if they're not taking their own socially responsible investing research seriously, then why should we, right? Why should anyone?
Yeah, I think Nick made a really great, or Nick had a great way of summarizing this, right? It's sort of aligning investments with values, and that alignment really needs to be top to bottom, and for your own firm as well to be consistent and authentic. I think a lot of our listeners in the audience are probably thinking about this kind of elephant in the room, though. Wait a minute, isn't the purpose of investing to generate return and manage risk? And so, I guess the real question here for a lot of them, aside from the social issues, and I appreciate that you can't necessarily separate them, but talk about how the performance of an ESG portfolio stacks up against, say, a more traditional portfolio without that consideration.
Sure. I can lead off. So the common belief is that there's not a lot of research on it. There's actually quite a bit. You can go back, anybody who wants to learn more about it. 2015, there was a meta study, sort of a review of the literature out there. There's been over 2,000 studies examining the link between performance and ESG criteria. And DWS and the University of Hamburg did a big meta study in 2015 that you can find out there. Just Google DWS ESG study. They found about 90% of those studies had non-negative correlation, so either positive or neutral. About 62% of the studies out there showed positive, maybe a little bit less than 30 neutral, and only about 10% showed negative correlation. Now, that doesn't mean correlation's not causation. I think you would be hard-pressed to find many people who would say that ESG was the direct cause of the outperformance, although many people would believe that. I think that's not exactly settled science, but I think it's clear that there's not a ton of research that shows that it's causes underperformance. I think most of that is just anecdotal. Only 10% of the research shows underperformance and 62% shows overperformance. Who knows? I think that there's a significant amount of research showing that ESG assets lose less in down markets. There's a good piece of research came out last year from Morgan Stanley. They showed, looking at the last 25 years or so, about 20% less downside capture in down markets for ESG assets. And what was interesting is they found that across all asset classes, fixed income, alts. And they found it to be statistically significant. So we do a lot of financial planning as well. I think a lot of listeners probably do too. So we're actually tying assets to goals. And anytime you can find a way to lower downside capture on a portfolio, it's going to increase your alpha. It's going to increase, we do Monte Carlo simulations on our goal planning. So it's going to improve the outcome of your Monte Carlo. So as a fiduciary, I don't think that necessarily everybody should be doing this, because I don't think that everybody has the knowledge base to do it. But as a fiduciary asset manager, I know that there's a lot of evidence that I can lower downside capture by 20%, and significant research that shows that it could possibly contribute to upside capture as well too. So it's something that I look at for all of my portfolios, and I think fiduciary asset managers should take a look at it. That being said, it's not exactly why my clients look for it. They're looking to align their assets with their values, but as a fiduciary manager, I certainly don't have any problem with it. I think that there's quite a bit of evidence to point us in this direction that it's a good fit for the fiduciary model.
And James, what are you seeing on the performance side?
So it's interesting. Obviously, I'm familiar with the research that Nick shared, but for me, it's not so much about the financial performance inside the portfolio. It's more about the economic performance, the potential economic performance outside of the portfolio that I think should really drive interest in socially responsible investing. To Nick's point, he was saying that's not why his clients come to him, to begin with. I think to the extent that people are able to connect the dots in terms of how companies are impacting them outside of their portfolio, then it makes sense for them to kind of try to use the power, to leverage the power that they have as investors to improve their lot in life outside the portfolio. So the tobacco example that I gave earlier, I think highlights this pretty well. You make $1,000 in your portfolio, but then maybe you're hurt somehow outside the portfolio in a larger amount. Basically, to try to stop companies from putting money in our right pockets in our portfolio while taking money out of our left pockets outside of our portfolio. Because the number in our portfolio, I think, is just one of many numbers that can impact our life. There's also insurance payments, there's medical payments, there's taxes, there's your salary as an employee, there's all kinds of really important numbers, and companies have a hand in impacting those numbers outside the portfolio as well. So I think that's something that shouldn't be overlooked in this conversation about, is ESG good financially? I think there's a broader question of, is it good economically?
I think that's a fascinating way to reframe it. Reframing the economic consequence of the decision sort of more broadly, I think is really unique, and I think speaks to a lot of fiduciary wealth managers' idea of managing holistically, right? The idea that I make a ton of money from an investment that blots out the sun and kills everything on earth, so I then can't spend it. That seems economically, untenable. So I do think that expanded perspective is really helpful, because it's not just financial, it's economic. So I think that's really smart.
I think there's also an element that, and I know I'm guilty of this sometimes. So I think it's always good to kind of like shine a light on your own kind of bias or maybe a misconception you have when you think about things. Like there's a bit of a false dichotomy, right? Like ESGs are just, are going to be, we're only focused on the warm and fuzzy, right? We don't care about performance, and these other ones, hey man, I'm a robber baron, profiting. That's all I care about is money type of thing. It's like, no, listen, I can invest in stuff that does good in the world or that's meaningful, important to me, like green energy as an example, right? Whether it's Tesla or it's other things that are making the world a better place, or I think a greener future for our children. It has all those benefits you were just talking about, James. But look, some of this stuff is also just whooping ass when it comes to performance, right? Because it's like people get it. Like this is the future, right? We are going to be driving electric cars. Sorry, guys who like to roll coal, your days are numbered, right? Like this stuff is coming, whether you like it or not, it's going to happen. So a lot of these things are going to be very good performing stocks, right? They just are, and if they're incorporated in an ETF or a fund, you're going to be okay, right?
As a bit of a finance geek, I've got another follow-up question on performance for both Nick, you, and James. And that is, given the meta studies, right? The study of studies, results suggest that ESG may be a positive performance factor. The follow-up question for the geeks among us might be, why? What do we think is the driver that sort of impacts performance positively? So James, I'd love to get your take first.
Sure. My perspective on this is pretty straightforward. If you have a company that's profitable today, but it's terrible to its customers, it's horrible to its employees, and it's the worst for society, how long is it going to stay profitable? So the basic idea is if you're treating all the stakeholders well, that feeds into a sustainable long-term form of value financial value for investors. So, if you believe, that society is moving in a more socially responsible direction, then companies who are, treating their employees well, companies that are treating their customers well, and companies that are treating society well are going to benefit because people are going to want to shop preferentially at the companies that are doing the right thing. They're going to want to work preferentially at the companies doing the right thing. Governments are going to regulate the companies that are doing the wrong thing, right, which could potentially lead to outperformance for the companies doing the right thing. And ultimately, that means investors are going to want to preferentially invest in companies that are doing the right thing. So, it's sort of this idea that people are the ones making these decisions about which companies to invest in, which companies should do well, which companies they want to shop at. And so if you treat people well, there will be some reciprocity. That's the theory. That's the theory behind stakeholder capitalism.
Yeah, good. Thanks. John, it's funny that you have that as a question that you wanted to ask, because that's the question that I ask all of the asset managers that I talk with, whether particularly the ones who don't hold themselves out as ESG asset managers, but incorporate it anyways, as many of them do. And I had this conversation with a large asset manager. I won't name them, but one of the things that they said, and they don't go to market as an ESG firm, but they actually have a pretty decent ESG integration at their firm. And he basically said that he thought the best description was ESG is a proxy for quality. And quality can be, and whether this is true or not, but I thought that this was an interesting description of it. Quality could be described as 20 or 30 different things. They probably have higher retention of talent than their peers because they treat their employees better. They have better labor relations. They are probably less subject to spikes in commodity prices because they have better energy usage. They have cleaner balance sheets because they can get ESG or higher lending from ESG focused lenders. They're less subject to regulator action because they have cleaner activities. So you could go down and probably isolate 20 to 30 different components depending upon the industry where it might add accretive value to the underlying stock or potentially the fixed income or alternative. So I think it's something where the whole may be more than the sum of the parts, and you could look at ESG. Why did 62% of studies show some positive correlation to performance? Well, it was probably different depending upon what the assets were and what the study was. And I wouldn't necessarily assume that an ESG asset would perform any better in the future. We actually assume the same returns for clients in our financial planning, whether they incorporate it or not, whether they incorporate sort of a model that we have or whether we're customizing something out for them. But we don't assume any lower performance either. So we're not buying into it because we think that this is necessarily going to hit the cover off the ball, although our socially responsible models have outperformed our traditional models for the last couple of years, and that may or may not continue. Who knows? So I think it's a complicated question because I think that ESG outperformance or underperformance is going to vary based on who's managing the money, what are the assets, what's the secular market cycle, and to be honest, I think that for retail investors, they're probably not purchasing because they expect that it's going to give them outperformance. Some maybe, but I think it's an interesting question. I expect that there's going to be a lot more discussion and study of it over the next half a dozen years or so.
I love the way you summarized that at the beginning, Nick, this idea of quality. And I like it in particular because you could argue that that's an economic concept, but for me, that's actually a philosophical concept. It actually makes me think of Zen and the art of motorcycle maintenance, right? Sort of the central premise of that book. And for those of you who haven't read or listened to that book, if you like philosophy, it's a great piece of work, a real classic. The interesting thing is you both, Nick and James, talked about real long-term drivers of outperformance. Talking to a couple of trading friends in prep for the show, I think there's also a key short-term driver, which is simple preference, and that leads to increased demand for those companies, the shares of those companies that are perceived to be better on the ESG scale, knowing that others are going to perceive that and want to trade into that. So I think there are both short-term and long-term reasons that these things are outperforming. And really excited to see the long-term play out, because I do think this idea of quality over the long term is gonna have a real economic impact, and is likely going to reward clients who've gone that direction.
This is how you know you're doing a great show, is when you have like the exact same brainwave thoughts as your co-host here. He started talking about the simple supply and demand kind of concept for one of the things that impacts performance, especially in a client's portfolio, obviously is are the stocks going up or are they going down in value? Right? And what drives a stock up and what drives a stock down? Sometimes it's irrational. It's not tied to, is the company more profitable than another company? It's demand for the shares, right? Do people believe in the long-term value of Amazon? For years never generated a profit, right? But it kept on going up and up and up. And if you were shorting Amazon, that was a rough ride for you, right? Because people believe in the future of that company. And I think some of that must be at play here. Is like, hey, I see that this company, it's doing well in the world. It's creating the environment, the world that I want to live in. I don't want to be in these oil companies or these tobacco companies and so forth. I want to invest here. And then to the point you made earlier, Nick, I have to believe there's some of this in there, and I'm not sure we can quantify it. It's like, if I've made that commitment, kind of that social contract with myself of this is how I'm going to invest, just because the market's down doesn't mean I'm like, well, I suddenly hate ESG and I'm pulling my money out, right? I almost might stay more committed to it, and therefore the trough, right, when markets are down, is lower for those portfolios. So it's always worth kind of highlighting that type of stuff, to kind of the attractiveness of that. And that kind of, I think, helps me bridge into one of the topics I think it's important for this audience is, I imagine some of the folks that are listening and or watching might wonder whether their clients will actually find ESG investing attractive, right? Like, oh, well, all my clients are at 60. Like the average age of a financial advisor is 62 or something like that. So chances are their clients are probably in that general range. What do you see in terms of demographics that find ESG investing attractive? Is there a spread? Is there like, hey, it's only the young millennials and young kids driving their Teslas and Priuses and stuff like that? Or is it more broader than that?
In my experience, speaking with sort of younger generation millennials versus older generations, it seems that I at least in my personal experience, I've noticed the trend with younger investors kind of understanding what we're trying to do a bit quicker and kind of getting on board, or having been on board really from the get-go. They they don't even really need me to explain much what I'm trying to do. Although speaking with members of older generations, very often a common question that I would get is, but are you going to beat the market? It's not so much, the emphasis on trying to do the right thing. It's more a traditional sort of financial approach. Like, okay, like that's an interesting take, but like, is this going to be like, let's talk bottom line here. Not to say that, baby boomers, uniformly hate socially responsible investing. There are many that feel this way, in their hearts that really believe in what we're trying to do. But just, as a on the whole, I would say that there's more appetite for this, among younger generations like millennials.
Yeah, and I actually, I haven't seen that, but I also have two offices in Massachusetts, and just tend to work within progressive communities. So for me, the demographic is specific in terms of location, and their one office in particular is is just in your typical progressive New England college town. So I have a relatively common practice in that typical client of mine is, between, let's say, 55 and 70. That being said, the clients that I work with that are not, part of my geography, that are in, Colorado or California or wherever they are, those skew younger. So my expectation is that this is something, and all of the data that I've looked at is that it is embraced more widely by younger generations, but the majority of my asset base and my client base is between the ages of 55 and 70. So I don't think that that's a limiting factor.
So it sounds like the interest is a lot broader than most people would think.
Yeah, I think so. And I think that the specific value set may vary by region, but I don't know. I've lived in the Midwest and the Southwest and Northeast and New England, and I haven't really lived anywhere that I thought that people's values didn't matter to them. So I think that they might be different, but I mean, if you're not asking your clients if there are any specific values they'd like incorporated in their assets, I mean, that's a conversation I would have. And that's how I started asking. I just, are there any specific values you'd like to see reflected in your investments? And you see if they say anything. And I think that that's something that you can ask no matter who your client base is.
That's really smart. It's interesting. And by the way, even if, let's just say it did skew younger, and if that was the case, like, hey, demographics, hey, people 40 and under find ESG investing way more attractive than people 40 and older. That's actually a common problem that many advisory firms are working on, is like, how do we get our client base to be younger? How do we attract younger advisors into the business, right? We actually need to get younger, because if you are that 60-year-old advisor who has a portfolio of clients, client roster that's 60-ish, you're going to need to kind of backfill some younger folks. You're going to need to relate to the next generation. And if this is something that helps bridge, it's probably worth exploring, I would imagine.
Yeah, I think to the extent that firms want to retain assets down generations, I actually haven't seen a ton of evidence that makes me think that that's a primary goal of firms. Most firms don't really have any strategy for how to do that. I think if you're set up mainly to serve retirees, it's just easier for you to go find other retirees than to serve clients that you're not really all that set up to do, or that you may not enjoy working with. And, I will admit, I am that advisor that some clients tend to go to when they inherit assets and feel as if their values aren't incorporated in their investments. I would say of the asset base in our firm, 40% of it was inherited. So it's not quite as much as earned assets, but it's pretty close there. The number one reason that somebody would find me is I just inherited assets and I don't feel as if my advisor is a good fit. And I Googled green investing, and yours was the first name that came up. That's a very common story for us, and we're happy to work with those clients.
It's interesting. So we just, we were talking a little bit about the demographics there and how people are finding you. And I think that's fantastic. And we're going to dive into marketing, I think, at the tail end of this, so that those advisors who are interested in making this a big part of their business can get some ideas on how they might attract clients here. But I wonder if when people start doing some research on ESG, there might be some common misconceptions that they have about it, what it means for their business, or even the clients have a misconception about what it is. So when they come to you, like as you mentioned, some people find you and they Google green investing, right? So what are some common misconceptions you may have to address when they walk into the office?
For us, it's more, I think people who find us tend to want to do something good generally. With their investments. And it's really a question of trying to educate them on how these things can be quantified. I think it's a lot of, well, how can you possibly quantify my values? That's a little bit of a sticking point, I think, when people think like, if I have this sort of abstract concept in my heart, how can you turn that into a number? That's not okay, or is that even possible? But I think ultimately, when you think about the impact that companies have, these are things that you can put numbers on. So, every year, tens of thousands of people die from, all global military conflicts. And that's obviously horrible. Each death is a tragedy. But then if you think about the impact that ambient air pollution has globally, about 4.2 million people die from ambient air pollution globally, according to the World Health Organization. It just sort of knocks war out of the water as an issue, just in terms of the sheer magnitude of the impact. So obviously people hate war because lots of people die and there's all kinds of destruction that happens. But if you hate war, you should really hate ambient air pollution a whole lot more. And so being able to put numbers on these things, I think, helps to discuss with people how we can actually quantify these things. And I would say that's probably one of the biggest misconceptions out there, that values are sort of, at least from my perspective, that values are sort of this thing that you can't put a number on, that you can't compare, you can't even really talk about. It's just, it is what it is. But I would say if you really want to have the best impact, you have to see what the ultimate impact of these companies are and put numbers on everything to really make your decision.
I agree. There are a lot of misconceptions that someone may come in. I think generally people come in because they want something different, and they feel as if they want their values to manifest in their financial lives, and that we may be a good resource for them for that. And we do use some tools. We work with we use Your Stake, which helps us. They have a values questionnaire and help us develop, an idea of what's most important to clients. And then they have impact reporting too, so that we can, similar to what James was saying, we can try to put numbers on, what if you make some changes, what's the impact? Does it actually reduce the amount of CO2 ownership? Does it, are there fewer cigarettes produced? Are there, whatever it is? And so we can quantify there using their impact reporting tools as well, and come up with a portfolio that's a good fit for their specific value set. I think one of the most common misperceptions, and I sort of have a line that I'll occasionally say in meetings, which is, socially responsible investing isn't just owning a bunch of granola factories up in Vermont. It's, you can have globally diversified portfolios that are a good fit for your values, and not have it just be, investing in kombucha. So I think that's, sometimes people come in and will say like, all right, so they won't really have experience with it, and they may wonder if it means that they're not able to participate in the markets in a manner that's similar to what they have done before. Like, oh, so does this mean that, we're just gonna invest in, small startup companies? So are we only doing solar investing now? There's some of that questioning, but I think it's important, if you're going to do this work, you need to have a way of educating prospects as to what this actually entails, because they are going to come in, some of them having significant experience and very clear ideas, and some of them thinking that you're going to go buy solar arrays for them and everything in between.
Are they surprised that you're not wearing Birkenstocks when they first meet you, that you're actually wearing a suit?
They are, sometimes.
But I'm sure that's a hemp suit, so it's all good.
Yeah. Well, I listen to a lot of Fish, so sometimes I'll just have Fish playing, and then they give me the head nod.
It's all good. So that brings up an important area, right? Which is implementation, and I'd like to take it at two different scales, right? James, why don't we start with you in terms of, how does the actual investment process look when we're talking about, the scale of work that you're doing? And then I want to hear the nuts and bolts of what Nick does.
So at Humankind Investments, we created this concept called Humankind Value, which is our estimate of what value a company is providing to humanity at large. So that encompasses value for investors, because investors are people too, and we want them to make a profit. We think that's great. They shouldn't be defrauded, right? Also value for employees, value for customers, and value for society, right? You could have a company that's creating tons of value for its investors, customers, and employees, but maybe its factory is spewing a bunch of air pollution, creating tens of millions of dollars of damage and medical bills, and all that stuff has to be incorporated. So we actually try to put a dollar value on each of those impacts that every company has, and that's how we come up with the Humankind Value. We also take into account the Humankind values of each company's supply chain partners, where we can establish that kind of a relationship, and roll that up into an integrated Humankind Value. And ultimately, that's how we weigh companies in our portfolio. So it's primarily Humankind Value based. So what's nice about this metric is there's an easy point for exclusion. There's kind of a clear point of exclusion where we say, well, if any company has negative Humankind Value, then we won't invest. I mean, it's kind of wild if you think about it. What it means is that there's a company out there that's on the whole destroying value for people. And there are many such companies that exist, like in that vein, that actually come out of our analysis, and so we don't invest in those companies. But from the companies that have any kind of positive net Humankind Value, we weight the ones that have more positive Humankind Value more in the portfolios. Subject and in our indexes is subject to certain liquidity constraints, and there's certain sector caps. But really, we try to let the Humankind Value shine, because that's ultimately what I think people are coming for.
That's such a cool idea.
And Nick, in your case, Nick, you could just buy Humankind, but I'm suspecting you haven't done that yet. So given that, how do you implement your firm?
So we use a variety of software. We use Morningstar, Advisor Workstation. We use Your Stake, which, like I said, helps us on the ESG side, and also on the shareholder engagement side as well too, and helps us. We'll essentially create a universe of investments that are a fit for our clients' values. They will have completed the Your Stake questionnaire, which we'll be able to create a universe of investments off of that, and then we'll be able to build a portfolio using the values data from Your Stake and the financial data from Morningstar to create a portfolio that's a good fit for them. And for the most part, we're using, like a lot of advisors, using mutual funds and ETFs, but we're actually, we have some individual securities that we're working with clients on too. And that's an area that will likely be expanding quite a bit next year, and hopefully developing a direct indexing option that will allow us to offer direct indexing based on customizable ESG value sets to capture that index type asset exposure.
Fascinating. So we're rounding home here, and I think one question we need to make sure we answer for the audience, rounding third, heading for home, I guess I should have said there. World Series is over. I didn't pay attention. The Red Sox got bounced, so it didn't matter. I think marketing and messaging is going to be something that's really important and top of mind for advisors and leadership members of firms that are tuning in. Both of your firms doing a phenomenal job, by the way. You go check out Green Future Wealth Investing, humankind.co, correct? So go check out the sites. The content is phenomenal. But if you look at most advisory firms, websites and marketing collateral, it's kind of boring usually. And sorry guys if you're listening and you're like, yeah, that's me, sorry. But anyway, it's usually a lot of vanilla-ish you're like, oh, we work with clients to help them have great lives. We take every client individually. It's very kind of bland, right? But in this case, I think you have to stand out a little bit more, right? ESG might provide, frankly, an opportunity to stand out. Now, Nick, I think we're going to kick off with you because you do some pretty interesting stuff, and people, I think, will dig this. But would you mind sharing a little bit about how you go about marketing your firm to ensure that your message reaches the right audience, and then when it reaches that audience, you have the right message?
Sure. Well, I'll say more broadly, since there are probably a bunch of non-ESG advisors too. Marketing is easier when you have a niche. So if you are struggling to differentiate yourself as a general practitioner, you might want to consider developing a niche within your practice, or maybe you already have one and you're just not going to market with it. But it's a lot easier to market as a niche provider. So we do Google ads, and would go after the green investing and socially responsible investing, all of those things that you would expect in the areas of our office. We also do a few other sort of smaller ad buys, and I think I mentioned already. I'm a big fan of Music of Fish, and so we go pretty deep into that fan base and advertise socially responsible investing on a bunch of podcasts. There's a podcast network, Osiris, that really caters to that community, and so we buy ads on there, and that's been tremendous for us as well too, as well as Google. I mean, Google has been a good source for us in our ad buys there, as well as our podcast dollars there. I think that they've been money well spent and pretty efficient. I think dollars go a lot further when you have a niche target, and so I think that there's a lot of benefit to going deep within niches. I also do a fair bit. My real area of expertise is in nuclear weapon divestment, so I do something within organizations that focus on nuclear weapons disarmament or divestment, and tend to pull clients from that group as well.
That's fantastic. I love the get a niche and go deep on it, and even the Fish thing. Just for those of you who don't know the band Fish is, just think Grateful Dead, Jimmy Buffett, Parrot Head type fan base. Like it's really strong. The people who are into it are really into the band, follow it intently, and so having that connective tissue with your prospective client, really strong move. How about you, James? You're about to jump in there.
Well, I mean, I love that Venn diagram of like the ESG and Fish fans like together. I think that's. I think it's genius. Like it's great. Yeah, no, yeah, it's basically right. Exactly. It's like, come on. And
pretty good overlap.
Yeah, and then I think Nick, you've got a great kind of instant connection with your clients too, which I think is great. Right. Ultimately, you're dealing with people, right? You're not just dealing with portfolios. So I think having that connection, I think, is really important. For us, I would kind of echo Nick here. We do spend on digital marketing, Google ads, that kind of thing, to bring people to our site to learn more about what we do and our take on socially responsible investing. We don't have kind of a specific niche in addition to socially responsible investing, so no kind of fish, unfortunately, anything like that. But
maybe you should get some fish. What's your favorite band?
Yeah, well, yeah, okay. Who knows? Well, I mean, that's taken. I think maybe I can do a Grateful Dead and ESG, combo, because Nick's got the fish fit, so can't compete there. So, but I think for us, the specific kind of socially responsible investor that we look for is someone who really cares, right? Someone who really understands the idea of kind of doing the right thing, and also believing that it'll kind of come back and actually help you, even if it's not directly in your portfolio, then maybe in other ways, sort of this idea of what goes around comes around. That's our specific like ESG client that we look for, more so than someone who just says, ESG is hot right now, like I want to jump on this train.
Smart. Well, gentlemen, this has been fantastic. I feel like I've learned so much. I know folks are going to want to follow up with you both. Real quick, best way for folks to follow up with you, James. Since you're right there, what's the best ways for people to connect with you and to learn a little bit more about you and Humankind?
Sure. Well, anyone who wants to learn more about Humankind investments can go to www.humankind.co. That's .co, and learn more about us there. And can also contact us through the site.
Yeah, and I'm at. You can just go to greenfuturewealth.com and see everything that we're doing there. I'm Nick at greenfuturewealth.com. If there is an ESG advisor out there who would love to join us, I am hiring. So
that's good.
Feel free to reach out.
Nice.
Job offers here. Yeah. You heard it first.
Yeah.
We didn't get a chance to talk about it, but there is a talent shortage in ESG, and we are all looking for folks that, even if they don't have experience, they have an affinity for it. And if you have either experience or affinity for it, there will be firms that will be interested in talking to you, so including me.
Wonderful. That's fantastic. Well, all right, gents. Well, thank you so very much. This is wonderful having you on the show.
Thanks so much for having us.
Thanks so much.
Yeah, thanks, guys. This was a lot of fun.
Yeah, thank you.
Thank you very much for listening to and/or watching this episode of the Augmented Advisor podcast. It's fantastic to have you with us as always. I hope you enjoyed this episode of the show as much as we did. Huge thanks to Nick Cantrell of Green Future Wealth Management and James Katz of Humankind Investments as well for joining us. It's amazing that we live in a world today where this stuff is actually possible, right? Like, at the beginning of my career, this would have been brutally difficult because their services were not really available for you to do ESG investing effectively and on a broad scale. And now all the information is at your fingertips, as you heard us talk about on this show. All the services are out there that are doing the scoring and so forth and just give you really good data so you can provide better services for your clients. Awesome, awesome stuff. Okay, as I mentioned at the top of the show, please make sure you subscribe to the podcast on your favorite podcast platform and do us a favor. Give us a follow on the socials, right? Blue Leaf is on LinkedIn, on Twitter. We're publishing every episode of this show to those feeds. Love to have you connect with us. And you know what? If you like this episode, chances are people in your community will like it as well. Please do give it a retweet or a share on your network. We'd love to have more people in the community listening to this show. All right, that's it for today. Please make sure you are staying safe and be nice to each other. We'll see you next time on the Augmented Advisor Podcast. See ya. Bye.